Happy Monday, savers and investors. Coming into this first week of August after positive market returns for the month of July, with over 9% return from the S&P 500, investors are cautiously optimistic that perhaps a market bottom has been found. Welcome to the Market Weekly Preview, What to Watch For. I'm your host, Daniel Caycedo, and this week's economic data and reports includes jobs, rental vacancies, and an updated number on the U.S. trade deficit. So let's break down what these upcoming reports mean for you, your investments, and your wealth in this week's What to Watch For. Welcome to the Market Weekly Preview, What to Watch For. I'm your host, Daniel Caycedo, and this week's economic data and reports includes jobs, rental vacancies, and an updated number on the U.S. trade deficit. So let's break down what these upcoming reports mean for you, your investments, and your wealth in this week's What to Watch For. The rental vacancy rate will be updated on Wednesday, and it is a quarterly report that shows the proportion of the rental inventory that's vacant for rent. For quarter one, it was 5.8%. According to the Census Bureau, both rental and homeowner vacancy rates decreased between 2009 and 2019 as the nation recovered from the foreclosure crisis. However, the housing supply then contracted further during the COVID pandemic. If this number comes in low again, this could mean continued upward pressure on rent prices, which further eats into renters' abilities to save and invest. On Thursday, the U.S. trade deficit figure will be reported. A trade deficit occurs when the value of a country's imports exceeds the value of its exports, with imports and exports referring both to physical goods and services. Put simply, a trade deficit means a country is buying more goods and services than it's selling. Many economists don't think that trade deficits hurt the economy. However, others believe that sustained trade deficits can pose an existential threat for a country, and there's continual debate as to what policies, if any, should be pursued to reduce it. A country that operates on a trade deficit is facilitating more consumption than production. Though the trade deficit can impact GDP, it doesn't suggest any action nor changes necessary for your investment strategy. Just stay the course. And to finish off the week, jobs. On Friday, the non-farm payroll jobs report, to be specific. Non-farm payrolls is the measure of the number of workers in the U.S., excluding farm workers and workers in a handful of other job classifications like government jobs, nonprofits, and proprietors. Non-farm payroll data is collected by the Bureau of Labor Statistics and reported monthly in its Employment Situation Report. More job openings means more upward pressure on employee pay, which is great for the majority of workers that are doing their best to save and invest during these highly inflationary times. Those are the reports to keep an eye on this week. Check back on Friday for the final reported numbers and the key wealth-building takeaways for you and your investment portfolio in our hindsight report. In the meantime, just keep saving and keep investing. Until next time, I'm your host, Daniel Caycedo.